Hello and welcome to the weekly Wild Wednesday webinar, everyone. My name is Michael Crosby. I'm one of the market experts here at FreightWaves, and we could not be joined by Brad Ganane this week. He is at a conference, I believe, in Jacksonville, so we hope it's raining on him for sure. But we're still going to get the party started here. I am joined today by Zacchaeus Kendrick Strickland III. Welcome, welcome. Can I call you Zach?
Sure.
Okay. All right, Zach. And so apparently we have added some more data into SONAR, we discovered, and we're going to talk about that a little bit today and maybe a few other useful tips and tricks that we can pass on to the users.
All right.
Yeah.
Yeah. So thanks for filling in this week, Crosby, for Brad, slacking in Jacksonville.
That's right.
So we added a few more tickers values this week to SONAR. A lot of them are just modifications to existing data. The one that we have pulled up this week or right now initially is the retail to wholesale fuel spread.
It's a twister.
Yeah, say that one time at all. And then we're going to get into a few more. We've kind of broken down some of the FMCSA data into other categories, so you can see just where the violations are happening in each state by category type. But first, let's go ahead and tackle the retail to wholesale fuel spread. For those of you that watch the FreightWaves Now videos, we actually have tackled this topic a few times, and I believe there have been a few instances that we have actually mentioned the value of having, rack price oil information, as well as retail oil, which is the obvious one that everybody kind of knows and is familiar with. If you've been involved in freight at all, you're very familiar with the DOE and their average retail price for fuel. And this is the difference between that DOE value and the wholesale or rack price value. And we have it broken down by each individual market. The one we have pulled up right now is the United States. So the value of having this, specifically if you're a carrier because you are purchasing fuel, a lot of them purchase it on the rack price level or the wholesale level. And but the fuel surcharges are passed along on the retail level. So as that spread between these two narrows, that also is an indication that the you're going to have a little bit of margin compression while the two values kind of catch up to each other. Because what happens is the wholesale price of fuel moves a lot faster than the retail reported price. The DOE reports their price on a weekly cadence. About Monday at 3 p.m. Eastern Standard Time. Sometimes that is actually 6 Eastern Standard Time, but right. A lot of fuel surcharge tables do not get updated until Tuesday morning anyway.
And caveat, this week was Tuesday to Wednesday, right?
Correct, because of the Martin Luther King holiday. So the deal here is that as this spread kind of narrows, you're going to have a little bit of margin compression. Very important to watch, but also as the spread widens, you're going to have the opposite effect. Your margins are going to expand slightly as the two kind of move in their own rhythms. So I'm going to go ahead and pull up our DOE USA price just to kind of illustrate how we've calculated this. And we're going to do DTS dot. I'm sorry, I'm going to do.
It's funny you typed that. That's what I was wondering what the difference was earlier.
Sometimes the brain does not communicate with the hands. So the difference here, and I'm going to go ahead and put this on our handy dandy dual axis chart. Actually, I can put this on the absolute chart. That would make it more valuable to see. So as you can see over time, as the chart runs through here, you'll see here the ULSDR, or the rack price, is actually moving up in a little contradictory movement to the retail price up here, which is the DOE average price. When this happens, carriers are purchasing fuel at this price, but they're not selling fuel, but they're right. Passing along this cost up here that you see on their fuel surcharge tables. Right. LTL obviously is a little different. They are based on a percentage. So they typically tend to make more money as just in direction of the fuel movement. So as it goes up, the fuel price increases. But the truckload carriers have a more one-to-one relationship with their fuel surcharge tables and the actual cost. They can legitimately run it at 6.7 miles per gallon, like is the equivalent of 31 cents a mile at the $2.95 or whatever the rate is that day, and they legitimately can pass it off almost exactly. The problem is that when they purchase the price on the wholesale side, they are getting a good discount, mind you.
Absolutely.
But the price up here is a little bit higher. They're going to compress it a little bit.
So would you say the rack price is not that the y-axis is going to be the same, but would you say this is closely related to WTI?
Yes,
it moves it's very volatile, more volatile than the DOE.
Absolutely. No, they do move in, the rack price follows more closely kind of the price of oil. The WTI, the West Texas Intermediate price for crude oil, that is in its unprocessed form. We have that as well. I'll go ahead and pull that up. You can see that it actually has come up a little bit. So this kind of leads the rack price a little bit. As this kind of bounces up over time, that's actually kind of good news for the rest of the freight market, because oil is a kind of a leading indicator of the economic expansion. I believe we've pulled it up over, I'll go ahead and pull up our crude production value, United States, and I'm going to overlay that with, if I can pull it up here, kind of, our proxy for the freight market, kind of a macroeconomic indicator in the freight market on the dual axis. And you can kind of see, obviously there's some seasonality in the CAS index as it follows freight volume patterns, but you can see there is a loose correlation here in kind of general trends as crude oil goes up. And this is kind of an economic indicator, if you will. But
sure,
as we produce more and more oil, our economy is based more and more on oil production. So as people are buying our oil and whatnot from other countries, we're getting that kind of injection of capital into our economy, but we also produce kind of raw materials that are based on crude oil, such as plastics and things of that nature that we ship off to other countries that get produced. So we sell them some raw goods, they produce stuff that we then buy back. The economy is a happy place to be. And the freight market obviously is transporting all of this stuff.
Right.
So there is a decent correlation here.
Are these the expenditures you got pulled up on the CAS?
I have the CAS freight shipments index. So this is just straight shipment volume. It is not an expenditure, because that has things such as fuel baked in it. So it'll be a little bit redundant if I threw the expenditures up there with fuel at the same time.
Right.
I kind of wanted to just show that, we had this kind of dip in the freight market in 2016. You see crude oil production in the United States was actually at a very low level. Again, oil hasn't been as big of as big of a factor in the economy prior to, say, 2013, 14. But as we've increased our oil production in the country, we've become more and more kind of, that's been kind of our mechanism for injecting a lot of activity into the economy, therefore money, giving us all jobs, super low employment levels, unemployment levels, I should say, and the economy expanding quite steadily for the last couple of years.
So what do you think the thresholds are? I know we talked about crude oil going up, so it goes up. If it's $80-90 a barrel, the oil companies are making money, but the consumers have less disposable income, But then there's also a threshold on the low side where if it gets so low, it costs more to produce than to actually, sell the oil. So what do you think the min max is there on, the crude?
So you're kind of hitting on the whole break-even price. This is why it's important for everybody that's involved in anything to do with freight to kind of keep an eye on the oil market. We have a market expert solely dedicated to tracking oil production and the United States and in the world, really. But these are things that actually do kind of have a huge impact on the way our economy moves nowadays. So what you're talking about is kind of like, what's the you know, you see back here, the WTI value was up over $100 way back when. This period right here, that was probably a little bit too high. What that means, though, is that it cost, they were making a ton of money pulling oil out of the ground, because it effectively cost them, I believe back then, it cost them around $60 to $70 as they were kind of developing technology, making more, you know, when you just drill one well and you don't have the pipelines or the equipment for it, it costs a lot more to do that. Now that over the last several years, we've become more, you know, we've dedicated a lot more resources to kind of making these wells. We've become a lot more efficient. I believe the break-even price is somewhere around $30 to $35 per barrel. Okay. So right now you can see this is reporting about a 50. I believe it's gone up a little bit more. I think we're sitting around $53 per barrel right now.
Right.
And that just, like, when we drop too low or the price starts dropping too rapidly, that actually is not good, because people will shut down their oil platforms because it simply costs too much for them to operate, making not enough money.
Right.
It's simply not worth your while. You wouldn't go and open up a cupcake shop and your flour was, you know, $50 a bag and sell your cupcake. Right. You know, you can make 10 cupcakes from a bag for, you know, $2.50 a piece. You're not going to do that.
Well, Chad and I were talking about that on Monday on the FreightWaves Now video, essentially, where we were talking about nationally how we have an oversupply of capacity. And it seems like every time I'm on social media, there's another regional carrier saying, hey, we just added another 10 trucks. And so we have the supply of capacity. And I joked that, you know, back in the day, the story was where the farmers would burn, you know, some of their crops just to lessen the supply. So the price of what they had left, what seems counterintuitive, and nobody's going to be burning their new Class 8 truck that they waited 9 months to deliver. But at the same time, there's nothing we can really do about the oversupply of capacity other than just, you know, wait for the market volume to pick back up.
Yeah, and that's what happens in the oil. That's why OPEC meets and tries to say, okay, we're going to stop producing X amount of barrels per day. They're trying to reduce the supply to drive the price back up. Places like Russia and Saudi Arabia, Iran, Iraq, Kuwait, they all have this dependency on oil to the point where their government will not run if they're not getting enough money for a barrel of oil. They literally have tied their entire government to the price of oil. That's why they are so concerned when America goes in and starts producing a lot of it on their own. We're not going to drive up their rate. But China and you know, some of these other countries are purchasing that oil over there, obviously because of geography, distance, and all that kind of stuff. So they're effectively trying to manage the price of oil over there so that their governments can actually just physically run, because a lot of those places are set up to have, they're subsidizing their own government with this.
Right.
Their infrastructure is dependent on it.
Right. Now, I don't know if you know this, Zach, but I used to work for an asset-based LTL carrier in North Georgia. So it's interesting when we look at this chart where if you could put your crosshair on there and just kind of, you know, zoom in over the dates there. So 2014 and 15 were pretty stellar for us. 2016 was actually not really a good year. So how low did the price get there in the beginning of 2016?
Yeah, you can see this is actually kind of a good example of why they shut down all the oil production, is because the price per barrel was $28.
Right.
They would have lost money had they produced oil at that price.
Right. So not good for the oil companies. I know, like truckload, especially LTL companies, though, where we were looking at the spread earlier, you've got that higher margin where it's based on a fuel surcharge scale, and then they're buying it, or essentially, you know, purchasing that at the rack price for much lower. So it's almost like a separate profit center sometimes, if you think about it. When fuel is higher, it seems...
No, yeah, and we kind of diverted into the whole macroeconomic value of looking at oil and gas and stuff like that, but that's more of the kind of operational benefit, and that's why we added this spread value in here. But all of it kind of works together. There is definitely some day-to-day interaction that happens on the fuel side. So kind of diverting away from fuel and resale, but I did want to mention, here's the tickers for the fuel spread. It's FUELS and dot the tickers for individual markets. And you can scroll down, or you can just kind of remember that it's going to be USA. And you'll see here that there's no category for it yet. This is under this blank category. That's because we just added these. Eventually, those fuel symbols will go under the energy hyphen price category up here.
Okay.
And kind of segueing down into our other new categories.
Are you saying that was your fault, that it doesn't have any text there, basically?
I did that on purpose.
Okay.
In no way was that unintentional.
Okay.
An unintentional happiness, because it allows me to go through these new tickers
for those of you listening. We're trying to keep you guessing. It's kind of the mystery box. You click on it, you never know what you're going to get. No,
I do that so that I can effectively organize my webinars.
Now, this next category, I asked one of our data scientists, and we didn't really get into it, but the controlled substances, we're kind of interested to find out what's in there. And now we can talk about some of the other categories.
Yeah, so for those of you that have been in the risk and management and compliance, we have broken down some more FMCSA data. We still have the violations resulting in out of service and other violations in general. What we've done is broken down these total violations into subsequent categories, allowing people to kind of see which states are showing kind of the most. We can just break down California. The value add here is simply kind of, where's the states that are going to be the hardest on the carriers.
I was going to say, I can't wait to throw this into a heat map and sort from high to low.
In terms of recruiting and operation activity, I hate to, I'm not trying to infer there's any kind of insidious behavior going on, but let's be honest, there's a lot of drivers out there that do various activities that may not be, smiled upon by the government, the DOT. So we have compiled these from the FMCSA to kind of let you know, here's the states that are going to have your highest chances of having a violation. Then you can kind of figure out, depending on your operational exposure, where, what states, you can actually even bury this into some costing. Because it does cost more money to operate in California, as most people already know.
Sure.
But you can actually have some sort of a lot of people in insurance kind of, they use this kind of data to say, well, the odds of this happening, has a 0.5% impact on the actual premium that you pay for insurance.
Absolutely.
And that's essentially what you can do here with the same kind of measure, because you're going to get charged your insurance premium in each of these states is going to be, depending on your exposure, is going to be weighted by data just like this.
Right.
So if you have a lot of exposure in California, your regional carrier, you literally can go in here and say, well, I have this much chance of getting a violation that's going to result in out of service, and it's going to be because of these 5 reasons here.
Sure. Well, we were looking at this a couple weeks ago. I know Maryland was high. I know Texas was high. California was high. So even if it's a state where you're either not domiciled or your destination, but if it's like New Mexico or something, if it's a pass through, you want to make sure that everything's in order, and kind of alert your drivers to some of these states where you're more likely to get a violation if they see something obvious.
Yeah, absolutely. So I think that's pretty self-explanatory. I think a lot of the people will probably, the people that are going to use this are going to kind of know how to use it to begin with, but that's just my 2 cents on what to look for in that. So without further ado, I think we have a few more minutes left to kind of touch on some freight market fun.
Freight market fun, starring the SONAR. Wow. Okay.
So I think one of the big stories of the week for SONAR, for those of you that are signed in as users, you have probably noticed there has been a big drop in volume, not holiday-sized drop in volume as you see here, but yet again, for those of you who don't know, this was the single largest drop in the outbound tender volume index for the country since March. That was not a holiday-driven drop. That's significant considering that we came out of the holiday, you see, a little bit stronger than we went into it. So we were kind of shocked to see this movement here. A lot of times you'll come out and you'll see something like this, or, you know, it'll just kind of fall off real quick. This actually went the other direction. So we had stronger than anticipated volume coming out of the holiday period.
I thought it was going to be bullish.
You did.
Yeah. Well, I mean, if people can't see me pointing at your screen, but if you want to put your crosshairs over there, you see this is essentially a 7-day average for our volume.
It is.
Right? So if you look at Thanksgiving, we had a peak, we had a lot going on. Totally drops off on a Friday, but you see that 6th day drops off even further. It looks like the peninsula of Florida there. But if you look over here for New Year's, kind of goes up. It's bringing up the average before we even get past the 7 days. So, you know, that was kind of our indication that things were going to be a little bit more bullish. But I think cyclically things do kind of slow down after we get that initial rush. I think if you zoomed in after the 8th, I think is when it kind of started to trend down.
Yeah, we had one big drop day. It dropped about 2.9% in a single day. For carriers and shippers out there, I think the value of this is just kind of like, you know, shippers can certainly know that capacity is probably going to continue to be pretty plentiful for the next little bit of time. We are in that kind of winter doldrum period. You know, the 3rd week of January is not like the hotbed of freight, although last year it was a pretty big I'm going to go ahead and pull up the DATVI, not USA. I'm sorry, not USA.
I was going to say,
DATVI.
Created a ticker there I wasn't aware of.
Not DNU, which is the National Freight Index. So this is the DAT. I mean, DAT creates this, and it essentially tells you like what the spot market is doing on a national level. It does not include fuel or any kind of accessorials or things like that. But back here around January 4th, you see that this value was still high coming out of the holiday period. I'm going to go over here and try to find the same approximate time. We are significantly lower.
What about 19%?
About 18.48% lower
on the rates.
On the rates
nationally, okay.
Yeah, versus that same time in 2018. So I think it's safe to say that we have kind of moved out of this super hot market period of time. You know, I don't think there's any kind of concern over not having like a summer season or anything like that, but it's certainly, I believe this is more like the anomaly. But it is important to note that volume is still actually relatively high.
It is high, and that's what I was going to say. It's not that the sky is falling. If you pulled up, what are you going to do, Atlanta? I was going to say Los Angeles, but either way, if you look at like the whole year.
Yeah, let's pull up the year for Atlanta.
Sure.
Because we do have the 6 major markets on a yearly basis. We're working on getting a few more added here shortly.
Now, when you say the 6 major markets, do you mean the 6
for
that
futures.
We will be trading
yes.
on March the 29th?
Correct.
Okay.
These are the futures markets. We have more data available in those markets for this particular index. So it's going to be Atlanta, Philadelphia, Los Angeles, Chicago, Seattle, and Dallas. Did I say Dallas?
I wasn't listening, so I was hoping you got them all.
Okay.
But so Atlanta, so the volume is actually up, right? Rates are down, and I think the only way you could explain that is just purely an oversupply of capacity. I mean, what else would you say?
Yeah, no, I mean, I think we've obviously gone through this period of time where the market's been very hot. We've had a lot of tax cuts this year, allowing a lot of carriers to purchase. They did a lot of OEMs. We're reporting backlogs, et cetera. Used truck prices, another thing that we offer in SONAR, are starting to actually slide back down. As I pull that up, just to kind of give some of you that may or may not have seen this, we do have this measure of used truck pricing, and it is a nice proxy to know kind of like, okay, how many trucks are being purchased right now. We are actually in the process of adding the new truck price orders.
Class 8s. Well, all the classes, right?
Yeah, the thing, but right now I believe it is Class 8s.
Okay.
Class 8 orders are coming through eventually. That should be a new ad here in the next couple of weeks. But we can see that we've kind of flattened off. Values are starting to come back down. The tax cuts have expired, if you will.
Okay.
So that's one more reason to think that, okay, people were buying up a lot of trucks throughout 2018. There's probably some drivers being added, and you can actually check that
Okay.
in the employment levels.
Man, that is a booger.
Yeah, I know, right on top, just sticky. Imp truck.
Now, if somebody didn't know the ticker there, could they just start typing employment and would
They
it kind
could.
of, okay.
Yeah, you can look at employment levels. These are good to kind of picture, this is a non-seasonally adjusted employment level. We can see that it is starting to trend back down again, as it typically does, but we're still very much higher than we were this time last year in 2018. Now, this measures things from, dock workers, back office, anybody that's involved in truck transportation.
Okay.
It is not straight drivers,
Right.
but it is a good proxy for seeing just how much the industry has grown in terms of employment over the last year.
Wow.
I mean, you're talking about.
Do you think maintenance is in there as well?
Yes, maintenance is in there for sure.
Okay.
So you can see year over year, we're still pretty big. It's actually 11. I keep clicking on this with my left hand. So if I go back to December of last year, and we still don't have, obviously January is not done. So we're approximately 2.5% higher than we were December last year.
Okay.
It's an indication that the industry has grown.
Yeah.
We've definitely, there's definitely some truck drivers in there.
Right.
that we've
Absolutely.
added. I mean, that doesn't mean that the average age has dropped or anything like that. There's still the ever-present driver shortage, and what the driver shortage actually probably means is it's just very, very difficult to hire new drivers at the bigger carriers, if you will.
Right.
But again, the average age is not disputable. 56.
Pretty high. Yes.
Eventually, that's going to become 57, 58, and then I'm tired and ready to move on.
I talked to one of the recruiting managers in town for a large carrier, and I mean, there's usually like 100 in the door and 94 out the back door every week. They've got more turnovers than Arby's, so it's just the numbers game they have to play constantly.
Yeah, no, that's why they have recruiting departments. Where do you go where they have legitimate recruiting departments? What industry?
Football.
They're called scouts.
Oh, okay.
Yeah.
Right.
They're not necessarily in need of selling people on playing football. They're there to weed out the talent. It is a totally different.
Well, I mean, even trucks have signage and stuff. Come drive for us and whatever. They have all kinds of stats on the truck there.
Yeah.
So
no, but it is increasingly difficult. So shippers should not be too excited that the market has kind of found a nice, I guess, balancing point.
They should be excited.
No, they should be. They should be happy with it. But what I'm saying is not necessarily like overly excited, expecting, okay, everything is going to be fine.
Well,
kind of like what the carriers were doing in the summer, jumping up and down, saying that the market was super hot and we were, things were going to go like this forever. I'm sure they weren't saying that, but at the same time, it's
right. Well, they should take advantage of it right now. I was thinking because the freight spend that they have budgeted could be less.
It's just so hard to have in the trucking transportation market is very difficult to kind of know when to hold them, when to fold them, and when to go buy a new truck.
Right.
It's you never know what kind of, you have to go grab this volatility. As I pulled up the outbound tender rejection index, which is kind of a proxy for capacity in the market. As the tender rejection goes up, you can kind of assume that capacity is going down.
Sure.
Just to give a little blurb real fast for those that may or may not have seen this before.
But this is interesting to me because we would always go to high-level meetings and, CEOs of large companies would just come over and say, hey, well, what do you see out there? And so, now you can literally see kind of what other people are doing, what the market's doing, and not just forecast your own budget based on internal, what happened last year.
Right.
Because at the end of the day, they just want to know. They can see
it's
not overall market share.
No, and that's kind of the value here. Is it's not anecdotal evidence. It's not something. It is actual activity-based data that you're looking at. That's going to tell you exactly what the market's doing right now.
Right.
So, I think we have run up against our 30-minute window.
30-minute window. So I don't think we have any questions today. So
we'll hang on for just a minute, as you know, if anybody has any questions, or you can reach out to us at freightwaves.com /sales for any questions about that, or just in general, go to our website. There's plenty of contact us information over here inside of Sonar, as well as freightwaves.com. Be sure to check out all the available content if you have any questions in our Sonar website.
We have lots.
Lots
of content.
And you can get there here through freightwaves.com by clicking on Sonar, or we've got a new landing page that'll let you dive into all the data. You can get on here, ask questions, reach out to us, all sorts of stuff to kind of learn more about Sonar if anybody has any questions.
I heard we're working on that landing page too. Just
We are.
To kind of tweak it up a couple notches. So we'll hang on for just a minute and see if anyone has any questions to fire off at the Sultan or myself.
All right.
All right, so actually we do have one question that came in from Rick Beasley, and Rick actually pointed out while the Sultan was putting the trend line there on the Atlanta volume, he suggested that you could actually put the Atlanta volume and the Los Angeles volume on there and do the whole year to date if you do it on a relative scale, and it'll actually show you. If you want to, we should try that right now just for Rick's sake.
Let's do that.
Take OTVI.ATL, see if this works here. Thanks, Rick, for that question, by the way.
There's no Rick Beasley. We wouldn't say your name if you asked a question, just to let you know.
Don't be scared. It's all good. Let's see if
So this will be a bonus.
Yeah, do it on the relative.
Let's do it on the relative.
Hopeful drum roll.
Oh, man.
All right, do a year.
1 year.
1 year.
Look at that.
So boom. All right, so you can see, 7% and 76. So you definitely know it's got to be the capacity.
Yep.
That's my theory.
There you go.
But we'll talk more about that next week. Thanks for joining us. And
have a good week.
Have a good week.